Oh, yeah. Nobody's here yet. So we're going to wait. There we go. I'll replay this clip because it's awesome for when people show up. 7 people are here. 9 people are here. All right. I'll play it now. You 9 people get this. Because I like it. Hopefully they're saying. I never know with this. It doesn't do it automatically on Zoom. So I don't know how you like. Oh, Benny Benassi, that's cool. That's not what we're going to listen to, though. Very good. Hello, everybody. Nice to see you all. Looks like Thomas here. Short Friday was in here a little bit. Yeah, that $27 bit was something, eh? We're definitely talking about that today. What is up, Maxie? Good to see you. Hello, Dan. Oh, I saw, dude. Let's see. Let's get some charts. Everybody loves the charts. We're doing a stock live stream. We need the charts. Everybody loves the charts. Oh, look at that. Charts. How about that, gentlemen? How about that? So, this certainly adds some spice to the mix. I think we have to talk about. I think we got to talk about the elephant in the room to get started here, which was exactly what I talked about today. Happened. I was literally like, oh my gosh, like, listen, everybody, like when I talk about this stuff, I'm serious, like, because like this isn't my background. Like this isn't my background. Like everything I've learned from piecing like pieces of the puzzle together online and stuff, just by like what the hell is going on. And I know I've written about this several times, but every time I write about one of these, like I'm looking at this, I'm like, here it is, like here it is. And every time I'm just like, maybe I don't know anything. Like, that's how it feels. So then, like, I just sat there, right? I remember sitting here waiting for this $27, waiting for this $27 to come up. Like, right? Okay, so after the open, obviously, like with the open. It was like, okay, I got a little worried because like I was looking at this pre-market. I think as soon as I finished, it was either like as soon as I finished making the video or while I was making the video, like I noticed on Chart Exchange, like I noticed the total number of shares available to borrow. Like first off, it went up to 1.8 million for like 3 hours. And then it went down to 1.2. And then it didn't go back up before pre-market. So I was like, oh shit. Like, they just borrowed 600,000 shares, didn't short them in the pre-market, and they're going to dump that on the tape like right now. And I'm pretty sure that's basically what we looked at right here. This just straight diagonal line. And I think maybe part of the only reason why it looked like this and not just like falling off a cliff, I mean, they kind of just sprinkled it kind of throughout the day, just kind of lightly seasoned it. Like what do you call it? What is like the like crisp topping, right on top of here. And I think if it probably wasn't for the fact that SPY crossed, like SPX and SPY crossed that critical gamma flip line at 5,900. That was the point they had to get over. And then definitely once they're in 59.50, every single like level all the way on up is just back into call gamma dominant territory. So definitely much more stable. And we cruised. We did. We got back up over 6,000. It looks like we closed just a little bit farther down, but we're still definitely in that stable territory in the broader market, gamma exposure wise, dealer gamma exposure wise. And so I think it made it harder for them to really, really push this. But that's definitely what we saw early part of the day. Like it just got shorted. So then when I saw that happening, I was like, okay, like it's getting shorted. It'll just keep going, right? Like based on what I talked about earlier today, it was just going to keep going. And then I was like, well, let's see if I actually know nothing, and I don't know what I'm talking about at $27, right? I walked you guys through exactly how I made this assessment at $27. Yeah, I know, right, man? Like Shinsasu when it bounced. Should I trade this? Like, I know, man. I know. Like, I tell you, right, because like this is maybe like the sixth or seventh one of these like Friday gamma ramps, like late in the week gamma ramps that I've seen show up. And like over the past maybe like 6 months. And they kind of look like this, but they're also kind of a little different. And I don't know anybody else. I haven't been able to find like anybody else that says like, oh yeah, this is how I trade. Like I definitely trade off of this stuff, whatever. Like even when I talk to guys, like I tried to talk to some people over the past couple weeks. I tried to talk to, I don't mean to cast shade or anything like this, but I tried to talk to Gherkinit right over the past couple weeks because I was like, something's gonna happen here. Like I want to talk to this guy. He definitely knows he seems like he knows what he's talking about this stuff. Tried to like talk to him about this stuff and talk to him about gamma hedging and gamma exposure and like if he uses calculations and stuff like this. And he just got tired of my questions, I guess, and banned me from his Discord. I guess fine. Like it's your Discord, man. Like you can do what you want, but it's hard for me to like have confidence in trading this stuff because it's like it's just me like making this call. I don't like it's not like I'm reading a newsletter. It's not like somebody else. Like I'm like I have friends who are like, oh yeah, we all trade off this. It's like I don't know. Like I genuinely feel when I'm making these predictions, like I'm like doing these. I like this is what makes sense to me, but I don't know anything. So I hesitate sometimes to really commit significant capital to this stuff because if you commit and I'm wrong, then it's bye. So it's tough, but sure enough, 27 came up and then it showed that signal. I was like, okay. I posted this over on my Twitter page, right? So let's bring that up. Where do I have this? I'll show you the tweet that I posted. Is it this? Yeah. Right. So let me blow this up a little bit for you guys, but here's my tweet, right? So yeah, I mean, this is a good opportunity to talk about gamma exposure, right? So what this means here, right? This means that we made the right read on the gamma exposure there, right? So one thing, like when you look at unusual whales or you look at spot gamma, like the data that they present it's separated into call gamma exposure, which has positive valence, and it's separated into put gamma, which has negative valence. In fact, why don't we just go over and look at unusual whales right now? I'll point this out to you guys so you can take a look at it. If you have or you subscribe to these data services, like you can start doing this analysis yourself. Is this our GEX? Yeah. So let me move this up here. You'll see this. Let me move this down and then put this. Come here, you. There we go. So You should be able to see my unusual whales page here. Looks like you can. So, right. So this is like when I mark up my charts and stuff for you guys, this buyer GameStop, this is GameStop. So when I mark up my charts for you guys, right, like this is what I see. Like there's a bunch of different charts you can look at. So we've got, you know, daily gamma exposure by strike. We have daily gamma exposure. You know, it'll tell you where we have just kind of, it'll show you by the strike horizontally, by expiry, right? It'll show you all the composite call input gamma. And then it'll show you that you can separate it by strike. You can do this type of stuff. Like it'll give you a bunch of different charts. But really what I look at when I mark stuff up for you guys, when I'm trying to figure out like our key levels throughout the day, is this, right? So let me zoom in on this a little bit. It's just going to give you, like they just give you the data here in terms of put and call GEX. So it's going to tell you that put GEX, let me scroll up a little bit, right? So it's going to tell you put gamma is negative, and it's going to tell you call GEX is positive, and it's going to sum these two together and give you a net value. And then over here, the normalized GEX is going to tell you what percentage of the total net gamma exposure is at this strike. So, you know, 28 at 28, we have accrued so much in the way of call gamma today, so much, and put gamma too, so much trading at this strike today. So many new contracts, just very open, very late. Right, it's going to tell you that 8.3%, 8.38% of the total gamma exposure, total market maker gamma exposure, total call gamma exposure, net call, I guess, is at this strike for all expiries. Of all the gamma that's out there right now, 8.38% of it is at $28. It's 28 strike across all our expiries. And you can see right here, it sticks out. It's big. Okay. But what it does, and this is something I was trying to talk to Girk about that was not particularly successful in terms of a discussion. But in terms of call GEX and put GEX, it's going to give you a positive number for all call GEX, and it's going to give you a negative number for all put GEX, right? And, you know, he recognizes this. And, right, what this is based on when they present the data is it's going to present you this data because the assumption is that retail is long, both, right? That the majority of contracts that are bought long, that they're single leg long options on both sides. I think I talked about this earlier this week, maybe in Wednesday's video. Yeah, I think on Wednesday's video, where, yeah, that's true most of the time, right? So if you don't know, in the absence of any information, that's a fair assumption, especially on popular stocks. So like on SPY, if you're talking about like, you know, 0 DTE gamma, or you're talking about the Qs, or, you know, something like GameStop, yeah, first off, there's not a lot of long puts anyway. There's just not a lot of puts anyway. Puts are not, I've mentioned this before, puts are not commonly traded on GameStop because there is a direct correlation with the price and volatility and IV, which means that as the price goes up, implied volatility goes up. And as the price goes down, implied volatility goes down. So if you are long a put, you are short the price, right? You are bearish on the price, but you are bullish on the IV. You are long the IV, which does not help you when the price moves down. So you have that working against you when the price moves down. So only in certain situations will you see small amounts of long puts come on the board. But so what that means is most of the calls that are out are long calls on the part of retail, right? When you look at $30 or $35, like this is a lot of, right? You can assume that in aggregate, the majority of the gamma at this strike, of the gamma exposure for market makers is short gamma, right? Is negative gamma on their books, which means they have to hedge it by buying shares. So it's going to have those typical properties, those typical call gamma properties that I talk about on a regular basis. But that's not like, even though we make that assumption on a regular basis, like that isn't how it actually is. That's just a pretty good working assumption most of the time. what it really is like, if you are actually a short party, if you are selling short calls to the dealer, you're writing short calls to the dealer, and the dealer is giving you a quote and then buying them. The dealer is putting long gamma for that call, is putting positive gamma for that call on their books. So they're hedging that by selling shares or shorting shares. So like in actuality, like depending on what orientation your trade is, like to the market maker, that's going to shift like the district, like what valence of gamma is on their book. Same thing with puts. If you're shorting a put, then negative gamma and negative delta are going on the market maker's book, which means they're hedging that by buying shares. Okay. Now, when you go in and you look at like, okay, why use this rule of thumb? Like, why use assumptions and kind of generalities about these bigger positions in their character? Well, because if you wanted to know what the actual gamma was, what the actual market maker gamma exposure was for every strike, you would have to go through every trade and figure out what leg of the trade the market participant took, the trader took for every trade. And then you would have to go in and then like figure out how many of those trades corresponded to new open interest. And so like, if you go ahead, let's go over to a different tab for unusual whales. Let's go over to options chain. I'll show you what I look at. If you go over here, let's go over to our options chain, right? So like looking at what developed today. All right, we see our calls, we see our puts, we go down by strike. So like let's take 30, okay? Let's take 30. 30, we're going to open this up and it'll show you the chart here, right? You can see this is 7 days. So we can see here, like you can see, all right, well, we've got all this mixed up. If we go down to a day, can we set this for, how do we adjust the time frame here? Let's go down to 2 days and let's do 5 minutes. That's funny to watch. Look at that. Absolute bastards, man. Like bastards. It's a 700% trade. We'll come back to that. But right, so when you look at this and you look at like new gamma that's going in there at 30, and you're like, okay, well, we had, I don't know, in the past 2 days, we had 30,000 contracts traded. Okay, well, how much new OI was added? 3,000, 4,000. Oh, well, how do you know, right? How do you know which of those, like that's too big. That's too big a number of contracts traded. The volume is too large compared to the new open interest, and things are too mixed for you to figure out like, okay, how did this affect the dealer's gamma exposure? It's hidden. Like that data is too complicated. You could probably do like some kind of statistical regression and figure out that, okay, because you had like this percentage of orders at the bid and this percentage of orders at the ask, you could make an estimate that it was biased in terms of the bid. So it's probably leaning toward, you could try to make that argument, but the thing is, it's like, it's too big a number. This is too small a number here. 4,000 is too small a number here, hidden in this over 30,000 calls that were traded. So you can't do that on like on contracts. Like you can kind of on really heavily traded contracts, you can't really do that reliably. You can even like bump it back to 30 days and you can take a look and you can see here, right? Like it's difficult to parse. Although you could say, all right, well, as we bump out, yeah, like it's difficult, right? There's just too much volume and the trades there's too much volume compared to the new open interest to be able to discern really what you're looking at here. Okay, Now, sometimes, and this is what I was able to do with 27 because I was curious, right? If we go in and we say, okay, well, let's take a look at open interest because I saw back on, what was this? This was yesterday. Unusual number of puts. I think this was yesterday, or was this? Yeah, this was yesterday, I think. Unusual number of puts came in at 27. And I was like, ooh, right? If I see, that stands out, right? If I see something like that, if I see an OI number, like, okay, 30, if they're 2,000, right? The position, there's 33,000 calls there. So that's not like, I'll look at that, but that's not, okay, half puts, half calls, some in the mid. This is kind of normal activity. But 27, 2,000 new calls, 50% increase in OI at a not round number that doesn't correspond to a technical average or anything. That's weird. So let me look at this. Let's go down to 2 days, 3 days, because I think this is Wednesday's trading. Okay. And we go in here and we look at Wednesday's trading. I think this is when this came on the board. And on Wednesday's trading, we could see that this was disproportionately at the bid, which meant when these were added, right back on the 15, actually, let's bump this out a little more. Yeah, these are, you can't quite see it on this chart super well, but let's see if we can see it here. 15th, yeah, right? Big increase at the bid. We can see that these were disproportionately at the bid for this week. And we had that big expansion in OI there. Okay, so if you can isolate a strike and you can get a strike where there's not a very large amount of volume, and you can see, okay, well, 50% of the total OI, there was a 50% OI increase. And almost all of that OI that was increased was for one leg. Then you can say, okay, for this strike in particular, we can get a more precise understanding of what the dealer gamma exposure is. Because you can see that, okay, whatever this strike was, it just increased its OI by 50%, and all of that 50% was at the bid for the trader in the market. You know the market maker is long that gamma there. So that market maker is going to be hedging those puts, those long puts on their books by buying shares. Now, when you go back and you look over here again at this table and you look at the put gamma, it's going to show up as red. That's what I pointed out on the charts. That's what I pointed out today, right? It's going to show up on the chart as put gamma. It's going to look like a position that traders took by buying long puts, and it's going to look like, well, okay, there's going to be a consistent kind of hedging pattern down here. We knew, though, that a sizable portion of that put gamma was actually negative gamma on the dealer's books, not negative gamma on the trader's books. So that the dealers at that strike were counter to what is the common sort of rule of thumb, which is helpful when you have too much data to comb through. If you have too much noise, you can't figure that out. You can't parse that. But when it's clear enough like that, then you can figure out, okay, the dealers, now typically by this number, they would be doing the opposite. But in this case, they're going to do something that's not indicated by that put get, by that under that assumption for put gex. And so we're able to figure out, all right, actually, if I'm reading this correctly, they're actually going to buy shares when the price gets to that level. And that's what caused that bounce. Okay. Now, after that occurred, because I think what we saw in our chart here, let me go back over to our charts for today. What we saw in our price action. Oh, come back. Where'd you go? There we go. What we saw in our price action, right? What the dealer response, right? What was actually just the effect of kind of traders trading that that dealer gamma exposure? What was that effect from hedging? Is it was this. Okay, not a lot of shares, but it was this, where this moved down, where we had some shorting, just got eaten up. And then we hit 27, and then enough traders who saw this happen went, oh, taking this trade, took the trade, and then they got here, which was their first, I guess, is the 100, I guess is the 100-minute moving average, and then they sold here. But after this, no more shorting happened. That was kind of it. Nobody wanted, I guess, to invest the money in the shorts, maybe because somebody knew we were going to get this. Now, this was not a result of that negative gamma being hedged on the dealer's books at that 27 level. That just gave us this kind of brief support. And then day traders, options traders just took this for this little reversal and then made this little trade. And then they exited here, and that's why we sold off. We sold off back here. That was it. But whoever did this, now this, I was sitting here, like I folded my arms. I was at my desk. I teach I teach a Latin student online. That is not from a South American country, but like I teach Latin to a student online at 8 p.m. on Fridays, or what would this be? 2 p.m. Eastern time on Fridays. And so this was a bit before that. And I was like, okay, I was looking at the charts and I was like, okay, what we just saw is exactly what happened. This pattern, right? This straight diagonal kind of line down. This, we had a key technical level. Is it going to hold? Are we going to capitulate? They're going to, short it a little bit, right? If we go back, before we get into this, if we go back to 12.5, same thing, same kind of archetypal pattern. So let's go back to 12.5 here. Here we go. Okay. Shorting, really heavy shorting, lots of shares on, and then kind of drift down, right? We pop up in the open and then sideways and then kind of drifting down. And then on the day that this happened, we abandon our channel. We flaunt this technical support. We go down, we go down, we go down. And then all of a sudden at 145 exactly, 145, that's when this happened. On December 5th, Roaring Kitty tweeted the time you cover tweet at 1:45 p.m. He tweeted it at exactly 1:45 p.m. And so I was sitting here at like 1:42 and I was like, it's going to happen at 1:45. Like I was just sitting here, just like, it's going to happen at 1:45. It's going to go up. It's going to rocket at 1:45. And I was like, the whole day I was like, man, like, I just went online and like, I talk about this stuff. And I'm like, I really hope people don't lose money because of this. Like, I really hope, like what, I don't know anything, and then I was just like, but if it's going to happen, it's going to happen at 1:45. And then what do we get? Oh, 1:45. We started to take off a little bit beforehand. Actually, I saw this. This is what made me kind of smile. I was like, oh, is it going to happen? Right? We were tracing back to this moving average here. Like, is this going to happen? Are we going to go up? And then sure enough, kaboom. So these were these exact dynamics in play that I talked about in my video today, in my post that I've been writing about this week, that I've been talking about happened on 12.5, right? We had the exact same gamma setup. We had the exact same chart. We go back to one of my articles. I pointed this out. Let's see. Let's bring this up. This is a nice thing about saving your work, right? Because then you can go back and you can see, hey, did I get this right? Hey, like, oh, this is a little big. Oh, we're also going to talk about this. That's going to be cool. We'll do a little bit of that. Here, I think. Yep. Okay. Can we zoom in a little bit? Right. So what was different is we didn't have this support at 25. But basically, we have a clear zone differentiated here between, you know, this area that had negatized, right? We kind of traded up along here. We were fighting to keep in the technical paradigm down on 12.5. And then we got shorted a little bit, few 100,000 shares. And then we drifted and we drifted and we drifted right down to here. And then right when we were about to cross below about 26 is when, right at 145, Roaring Kitty time ute cover comes in, and then cowabunga, we just go straight back up here, run this whole gamma ramp all the way up through 30, all the way to 31, and then traded back down by the next day. Yeah, so same setup, right? Nice smooth transitions, a lot of call gex overhead. Call wall was here at 30, which was, you know, very close to the end of the week. A lot of gamma built up for that expiry that was about to expire. IV had come down tremendously. We were coming off of a bunch of shorting. It was the beginning of another one of these volatility cycles that Gherkinit described in When the River Runs Dry. Really a great, hey, you know, go check out, like really go read that. It's very great work. Like that guy did a very excellent job putting that together. I'd really recommend reading it. It's very informative. You know, some of the concepts maybe are a little difficult to discern exactly what he's getting at, but it's worth reading several times. And then with a put gex, a negative gex space underneath us, and then as we got close to, you know, I don't know if it's because the 25 started to exert some kind of influence here, or maybe 26 was of a different character. Maybe this was one of those strikes that was deceptively put gex oriented. But at 145, we got that tweet that came back up here. Now, if we look over now at our setup for today, right? Not exactly the same. We've got call wall there at 30. We have a bunch of dealer gex up here, right? Dealers are going to be short these, or they're going to be, yes, short these calls, which means they're hedging them by buying. They have negative gex on their books. They've been able to, as I talked about, charm, right? Delta decay over time. They've been able to sell a lot of their delta hedges. And then here too, right? As the price drifted down into this negative gamma territory, this was the tricky spot, right? This was the tricky spot. Because this looks like, oh, it's going to slip. It's going to 25. When we know that actually this was a supportive level, because this level went counter to what is assumed about the hedging characteristics of this primarily put gex dominant position. But then 145, right? Why did it happen at exactly the same time? Why did it happen? We had the same setup. We had the same type of shorting. We had that same entrance into a volatility cycle. We had that same movement throughout the week. We had IV bleeding. We had people getting caught by surprise by that level of shorting after a long period of trading up. And then at 145, we get an exploitation of the same types of gamma and volatility squeeze ramping dynamics that we saw. Now, we probably didn't go higher because we didn't actually get a Roaring Kitty tweet. So is it that, like, is there some sort of like algorithm that reads this? Like, is it possible that Roaring Kitty's tweets are something like his posts, which get responded to algorithmically, are now programming the algorithms to replicate what he is doing? Like, are they going through this like machine learning process where they like learn his pattern so that he doesn't actually have to do anything, and the market makers, like whatever these algorithms are, will execute the buying patterns to replicate this price action regardless of whether he's doing anything or not? Like, that is crazy. If that's the case, that's crazy. Yeah, Shukri, that's crazy. That's nuts. I'm trying, my friend. Good to see you. Great, babe. Yeah. So I don't know. I don't know how else to explain that. Like, I mean, I think I've yeah, Bowser, you got this, man. See, that's it. Like I have to think that there are like they I wonder if they're trying to use the algorithms to figure out and anticipate when he will tweet. I suspect that they might be using these to predict when he will interfere, if he will interfere in their volatility cycles, right? Because clearly what Gherkinit has shown is that these volatility cycles have a pattern, right? Gherkinit described this very how would you say this? Explicitly. Roaring Kitty, right? I think with this time is a flat circle meme back in April. This is what he was referring to. He was referring to the cyclical nature of this ETF FTD cycles. And I think it's possible that these volatility sellers, something like that, right? That what they are doing is like attempting to preserve these types of cycles, but it's clear that they got taken by surprise in May, June, and they only got saved by Cohen's escape valve. Like, it could have been really bad for them. I mean, kudos to Cohen for doing that, because that has now won the company a serious amount of money, which, okay, it didn't cause whoever had these positions to blow up in May and June. But, here we are. We're still doing this. Like, this game is still happening. So I wonder if they started to. I wonder if, because he's done this now prior to 2 volatility cycles. He did this prior to the September earnings report, and he did this the week before the December earnings report. And they replicated. We didn't have an earnings approaching, but volatility was still high because of the liquidity crunch that they ended up being in because of what happened during 12.5 and 12.10. But they replicated this pattern, and it looks like an algorithm basically said, oh, all right, well, this is what happened last time, so we'll just prepare for something like that to happen again. So there was some program or some predictive, like maybe it's an AI learning thing, machine learning, basically said, okay, here's the setup. This is what happened each of the last times we got something like this, or at least certainly the last time we got something like this. Just execute the order, right? Regardless of whether he tweets or not. And if he does tweet, it'll just send it into the stratosphere. Which I think that's what would have happened. If he tweeted at 145 again, it would have just sent this, like, it would have sent this back into the 30s. That's what would have happened. Because as it was, we had 2 million shares traded in 15 minutes here. 2 million shares traded in 15 minutes. On no news, on no technical indicator. As I said, day traders already did their thing with the 27 bounce. That's what they did. Bounce at 27. They probably figured out what I figured out about the gamma exposure there. Traded up to what is this? This is the 20. I can't tell the colors because I'm in sepia mode. I think this is the 20-minute move, or 25 minutes. So 100-minute moving average. Yeah. 25-minute or the 100-minute. And then they exited their trade, right? That was the resistance mark. So they were like, oh, okay, pick it up, scalp out. But then this was something else. So I don't know, right? We can look at the structure, and we can look at the structure of this, and we can diagram the exposure. We can diagram the gamma exposure, and we can look at the IV levels, and we can look at these patterns, and we can say, okay, like, this is how it can happen, but it still takes somebody to pull the trigger. Now, why that happened there, I think just so conspicuous that it was at 145 again. So conspicuous. Very interesting. I don't know. I can't wait until this is, I can't wait until we're at the other side of this and we can just figure out what the heck is going on here. But it's very interesting. Let's see. Bowser's got an idea. Yeah. Yeah, I mean, it definitely gave it the support. But there's not that, but there wasn't like that many puts there. There wasn't that much gamma there. Like, because they hedge it dynamically. So it like it gets hedged in here. And then the strongest point is like the time to go back in the other direction is here, right? Because you stop having momentum like in your favor. Like the highest resistance point is here, and then you still get delta, and then gamma kind of goes back the other way. But unless you want to push through that, overcome that demand, like you have to invest more in short shares, and that didn't happen here, right? People were waiting for that. Traders were waiting for that. They picked it up, and then it came back, and then it hung out here, and so like it just kind of kept buoyant, but. Maybe some of them, entered here on the expectation that this would go up, but this is too much. This is too much. And you can't say this is retail trading. God, like how would retail even find out about that? Like, no, how would retail even like learn how to like predictively trade options based on calculating like market maker gamma exposure by strike? Where would they learn that? That has to be one or more institutions that like have knowledge of that type of effect and just waited to pull the trigger there. Like ahead of time they decided, oh, we'll do one for. Yeah, I mean, yeah, other funds can. Yeah, and Michael brings up a good point here. Yeah, we were, right? That was the same thing, man. We were set. Like essentially we were basically going to do that. Let's bump out, right? Let's bump out to our weekly here. See, we didn't. Like if we just kept going down, like we might have. We did close the week slightly below I guess we did that back here too, though. Slightly below the 200-week moving average by about like 40 cents, 50 cents, 40 cents, 43 cents. So, I mean, not optimal, but we held the trend here, which is cool. Yeah, I'm sorry, you're not there. You're over there. Yeah, good point, Michael. Well, that was what it looked like to me. Right, that's what it looked like to me back here, here, because we were set. Okay, our like what was really important there. We had so throughout the beginning of the November run, our important technical level here was the 50. Like if you want to go back and read some articles, like you can take a look at this. Back like early November, it became very clear because of this move here, like this candle, this pre-market candle that like weirdly shot down to, this was in the 23s at this point, but shot down here and just picked this up right here. Right, this was some trade that was executed. So this tells, like when you see stuff like this can also tell you like, oh, somebody important is like using this indicator, this technical marker as a navigating indicator. Because why would this go exactly to this line? Right? In pre-market trading, hours before retail can trade, hours before anybody can trade, why would you have this order just shoot down there and then come back up. That can be a tell. And we used it here again, got close up here, but this 54-hour moving average was a support point. And see, this was the fake out. This was the fake out on 12-2. The 11.29, 12.2, because when we dumped on 11.29, we pretty much touched the 54-hour moving average and then bounced back up. And we bounced back up into the close and into the after hours. And so the next day, it looked like, okay, we're going to open. Even if we open down, we're going to find support there and then maybe go back to the upside. But we didn't. We broke that. And then our next level down was the 100. And then we held that and we bounced and we moved up, right? We went down, we traded up, okay, down, but then it came back up. We were on top of it. We were trading on it. We slipped a little bit below it. We had our regression channel here, was a bit narrower at the time. And then we abandoned it. We really abandoned this support. And it looked like, okay, we're definitely going down here. We're definitely going back to test 25. We're going back to test 25. We're going to the 200 4-hour moving average. That's it. Like, I remember talking about seeing some of those put trades come in. And I even started to reposition, right? Because I looked this and I was like, oh man, that's it. We broke this support. We're just going to 25 now. And then who knows what's going to happen with earnings. I need to reposition a bit. So I hopped out of a bunch of my long calls that I had there. Took profits, started to set up some hedges. I was like, I got to reposition because we lost that technical support. And then I got banned from Reddit. And as I was running around doing that, and then all of a sudden, 145, in comes our guy, and we come right back into this this channel again. So, yeah, Michael, good to point that out. Just when it looked like we were going to abandon that technical support, right? We had kind of fallen below that RSI line. Whoop, up we go, staying on top of it. So for those of you maybe who didn't catch, my video earlier today, what Michael's referring to here is this RSI trend line. Okay, trend lines you can draw, right? You can look at trend lines on the candles. You can look at it at the price. You can also look at trend lines in the RSI. And I had not actually talked about this. I didn't mention this yesterday, but I realized it when I was actually making the video that I didn't mention it. I didn't draw it. So I took a look at it earlier this morning. And yeah, if we look at Roaring Kitty's chart, so Keith's chart is here. Come here, please. Friend. There we go. Friend, no. There we go. No, friend, no. I cannot get this tab where I want it to go. There we go. Here it is. Okay. Right. This is what he drew. So our guy, for the longest time when I was looking at this, I thought that this here on his chart was just and I mentioned this in the video today, right? I thought he was saying look at this. But that's not what he was doing. He was drawing a trend line. He circled this and said, look, so I also drew that, right? I drew that on my chart here. We can do the two of them there. And also, like I said, the way I drew it, and see, this is what you want to try to do, or at least I try to do when I'm drawing charts, because you see people, part of the reason why people kind of get mad at people who do technical analysis is they'll draw a triangle or something, and then they'll be like, oh, we're going to break out. And then it doesn't happen. And so they just extend it 4 bars to the right. They're like, oh, we're going to break out. It's yes, you can just keep doing that. But the point is you want to know if in the moment your technical analysis, your particular formation was forwardly predictive. If it's not, then it's not useful. Then it's only historically, it only works in hindsight. So you want to know if it's forwardly predictive. So what I did here So you can see, right? I only drew my 2 anchor points on this. It might be a little small on your screen, but you can see the anchor points are right here. I only connected these 2 points on this trend to see like, okay, at this point, was this price action, were the supports in here predictable when you were here? And I just, had this trend extend to the right so that I didn't draw it after this. This is just the line giving itself a predictable, it's just drawing itself at that angle. And because of that, right, yes, it was. Roaring Kitty certainly seems to suggest that it was. So if you did the same thing here, and I think I pointed this out back in October, I pointed this out then and I said, this same formation is happening, right? We got that little pistol, that little pennant on the RSI, but it's bigger, right? It's much bigger. And if you zoom in, is this log scale? This isn't log scale right now. I'll put it in log scale. It's clear. That's what Kitty uses here. Yeah, if you go in here, you can see a little pistol, a little similar thing, right? This is from COVID. This is the COVID bottom. That's what we got. That's the formation we got out of that. And that's why it's creating that same formation there on the RSI. And so, yep, I said, okay, we're going to break to the upside based on us touching this trend line there. It looks like that same thing. And, a lot of people were showing this in different ways. Oh, it's getting tight. Jake Boyastic talked about that with his TA. Some other people said like, oh, okay, bullish pennant. We're going to have this bullish pennant. Yeah, just like this was a bullish pennant that broke to the upside, right? I guess this isn't discernible on the RSI. Maybe if you go to monthly RSI, let's see. We do month. Not really. It doesn't really show up on the monthly. I mean, you get overbought, but we're not overbought yet on the monthly. So if we're going to maintain this trajectory, go back to our yearly here, then yeah, basically now. So it held up. I know Richard was talking about this too. Yeah, Richard Newt was also talking about this today. He did a great video. Guys, I love Richard's videos. Richard is great. He's a man of God, and he does really, really excellent analysis. Like there's a ton of stuff he's pointed out that's been super, super helpful for me. If you do not follow Richard's videos already, Richard Newton, like definitely go and give him a follow. Definitely go check out his stuff. Like he's really good. And what I like too about Richard's videos, very often, and you guys may have noticed this too, like Richard and I will come to similar conclusions by looking at different data, which is cool. Like, that's what I try to do with my approach. I try to use technicals. I try to use historicals, and I try to use, market maker, how I assess dealer exposure, delta, gamma exposure, like all these different exposures and how to anticipate their hedging principles. I try to use those like multiple sources of looking at things to try to like triangulate in on forecasting the price and what I think is going to happen and how to, structure my own positions. Richard uses some of the same stuff, but he also uses some different things. Like he comes to, I think like he looks a lot closer at some of the moving averages. Like he looks a lot closer at some other indicators on Roaring Kitty's charts. And of course, he has a much, much deeper understanding of what's going on with ETFs and FTDs. So I really appreciate looking at his stuff because, like I said, he also came to the conclusion by looking at different things today that we would find support at 27. So he does love to track the lows. He does do that. So definitely check him out there. This is a good question. I know Richard's been talking about this too. I don't know. I wish I knew. We'll have to look. If we go look, I guess we can do this, right? We can get a little jump start on maybe next week's analysis together. We can walk through some of this, together. Let's see. we can try to anticipate maybe what next week is going to look like. Now, the trick here, we had a lot less, right? We had a lot of our gamma actually start to shift into next week, but big gamma wipe, right? So almost half of all of our GEX is coming off the board. We won't know new OI until next week. But we probably did get a pretty interesting distribution of new stuff based on our volume. Let's check that out. Maybe let's see what our volume looked like. It's not going to tell us new OI, but where is it? Is it this? Yeah. Go away, tasty trade. Be gone with your advertisements, whelp. Not whelp, whelp. We like whelp. Where is it? Is it here? Did I just put it up here? Oh, I did. Okay. Let's see. So, right. So if you're looking at your data here, you're not going to get new OI information until 3 hours before market open. But you do get volume. Volume data is live. So we had 17,000 calls traded at 30. That's a lot. Mix bullish and bearish, slightly leaning towards I guess slightly leaning toward the bid. Bias towards the bid, mostly bid trades, mostly ask at 31.50. Okay. Mostly ask at 32, mostly bid at 32.5, mostly ask at 33, mostly bid at 33.5. And then mostly bid up here, right? So these are probably a lot of 35s. So dealers are long. We don't know if dealers are long these. We don't know. So we're not going to be able to tell about the OI, but there's probably going to be a lot of new calls entered here. There's going to be a lot of new calls entered here. It's probably going to be a lot of new calls entered at 28, which is cool. But let's see. It's hard, right? It's hard to estimate what our gamma is going to look like if we have so many new ones. This is why this is so tricky. Like, I have to do this. Like, the data drops at 6:30 Eastern time, and it's like that I have that much time. Like, I have only that much time to like pop out an analysis. That's why, like, gosh, if you're a firm and you can just like crunch this stuff automatically yourself, like, that's so nice, because then you can like work on it over the weekend. I'm sure that's what they do. Because everybody else gets 3 hours in the morning on Monday. That's it. So what is this going to do to our gamma landscape? Let's walk it out. So we're going to have a bunch of new stuff here that's going to make that much more positive. I guess here, not here. Don't have a lot of put kicks there. We just don't. That's it. We just don't have contracts down there. Look, this is next week. We don't have contracts here, man. There's no OI. No one's trading this. We have 1,000 puts at 26, and we have 1,000. Right. 1,400, 1,600, 1,600. We have some puts. No one's trading this. There's no OI. This is why Max Payne is here for next week. No one is trading this. There's no motivation for the dealers to push the price down here, purely based on option stuff, right? This is where I don't know about swaps. How far back can we go? Can we go look at the Nikkei stuff? Oh, I wish I had what we looked like then. I did write about it. Do I have that on my page? Let's look. All my stuff is here. I must have written like 150 of these by now. I hope my earliest, like my first month or so, was only on my Reddit page. I didn't have enough time to get that over. And so that's lost forever. but I think I was able to get back there. No, I think I lost that stuff too. Yeah. Dang, that's a shame. I lost about, yeah, like the first like 7 weeks of stuff that I did for Supersonic that got wiped with my yeah, that got wiped with my Reddit profile, and that got nuked on December 5th by Reddit for whatever reason. So the earliest it goes back is 8/19. Yeah, but you know, you can go take a look at some of that other stuff. That's a shame. I'll see if I can dig some stuff up, but so about the carry trade stuff, I don't know. That's probably something for me to look into. Right. I mean, this is where probability and hedging comes in, because if you're dealing with unknowns and you just don't have a way to get data, you don't have a way to get on it, then you just try to like assess, you try to like ballpark your risk and then hedge your position. So, what would you do to hedge your position? Sell some covered calls is good. I like to hedge my position. Like I'll sell, right, because I still have faith in like this overall bull trend. Like, okay, if we don't get to 50 or 60 for like another 6 months or a year or something, like fine, right? Fine. I'm fine with a slow grind up because selling covered calls is cool too. Like that's another nice way to you protect your position. Okay. Oh well, you shoot up super fast. Maybe you get a sign, like you sell 40s or something. You get a sign. Okay, you got to sell a fair bit of your position at 40, but like still a profit. I ask myself all the time. I'm just like, am I doing this to be rich because money, or like it just purely right? Like how much money do you need? Like, would you be happy with like doubling the amount of money that you have? Like, is that not an awesome thing? Like, yeah, it is. So it's like, I always try to hedge my position by guaranteeing myself real gains, like guaranteeing myself realized profit, rather than choosing not to hedge the position because of potential more profit in the future or something like that. But you can do that. You can sell covered calls. Although I will say, like what I said earlier, we are getting low in terms of IV. It could definitely go lower. If we look at our IV levels, we have seen lows, but like we could cool off a bit more. I think we could. I think Richard's right on this too. Like, it doesn't necessarily mean the bottom falls out of the stock. But could we get? I could still see us like at some point, but we are kind of looking. We are kind of looking. Well, no, see, we did have stuff below us. See, this is what happened here. Okay, like with the Nikkei crash here, this is what I remember. I know I don't have the images now, but like over these 2 weeks, we had a lot of long. We actually did have a lot of long puts build up. We had traders actually come in and start piling up long puts underneath us. That started to show up in the gamma data, definitely. And we can probably, if we go back, we can see the ratio here. Not super helpful, but we can see it. Yeah. Okay. So the Nikkei crashed. What here? This is when we bottomed, right? This is when we bottomed. Friday and then into Monday. Okay. This is when we got the crash. Okay. Look at what happened to our put to call gex ratio weeks before this. Okay. We went from, okay, this isn't crazy. Like these aren't crazy bullish numbers here. Okay. These aren't crazy bullish. Actually, this is worse than what we're seeing now. Or like we were moving up here when when we had numbers like our put to call gets ratio is like this now. So not crazy. Right, we topped. This was when we touched 29.91 in August or in July, just before July OPEX, which is the 19th. And then we started to go down, right? And in here, we just had put gex building up. Okay, we could see this, and you could see this historically reflected in the ratio because we can only go back 90 days here, but you can see this historically reflected in the ratio. Very bearish, right? Come here, you. Getting in the 0.6s, 0.5s, 0.79, 0.6, 0.7, 0.7, and then 0.9 on that Friday. Okay, so that's a lot of buildup of puts. And then you look at where we are now, even into last week. Look at these rates. Look at this. Like this is so bull. 0.25, 0.3, 0.2, 0.17, 0.19. The only time we had ratings this low was May and June. On the 7th and the 8th, heading into the 9th. The only time we had ratios that low in the past, I don't know how many years, was May, June, right? Go back to May, June. .19, and then of course 0.08, 0.04. Look at it just didn't even on the 14th. There's no gamma exposure because the market makers are fully hedged. Blew out the options chain. There was no more gamma to hedge on the 14th. So there's like 40,000, right? We go from like 2 million, 2 million, 2 million, 2 million, 1 million, right? It just goes away because they're not exposed anymore to all the gamma. They're completely hedged. Yeah, that was funny. But, right, and then we come down really fast, really hard. Yeah. So, I mean, it's not going to tell you, it doesn't, I've tried to see, it's minimally forward predictive. It doesn't really tell you, these numbers don't really tell you that, but they do tell you, give you a clear picture of like what was happening around that time when you look backward. And in terms of our numbers right now, like they are trending bearish. They have trended bearish. But we're still not seeing that. We're still not seeing that put build up. I mean, it definitely trended up overall. Like I guess it has trended up a little bit, but it's hard to tell whether that is because of necessarily too many new puts coming on the board, or if because just our price has moved down closer to where the puts are. Right. So that's the thing. This is like, you can even look, we do have some, right? They go down to 25, but there's nothing below 25 here. This is for all of our expiries. So as far as I can tell, like if we do trade down because of the yen carry and the Bank of Japan stuff, right now nobody thinks it's going below 25. Very few people, I won't say nobody, very few people have positions open to hedge that move. At least in the short term and coming up in our gamma data. So that's not being hedged with well, at least it's not being hedged with puts, which is different. My point is different than what we saw in August. That's about the most I can say as far as the yen carry stuff. The date, I think I mentioned this, but the date was the Bank of Japan meeting was on August 2nd. And then there was reaction starting on Friday, spilling out over the whole weekend, and then culminating on Monday. And then it reversed. and reversed. So that was August 2nd was the meeting. So they'll have the meeting next week, but if they decide to raise the rate, they won't raise it until March. And per IV, yeah, Shinsasu's right here. Yeah. 60 IV was it was what, 60, the 30-day, the lowest we had in 30-day was like 68. With the exception of this weird, yeah, this was also 68. Yeah, this was weird. 60, yeah, 68. It's the lowest we had. 11.7. This was strange because the market makers just like dumped it. Pre-market, inverse Chewy exactly the IV levels. But this was the golden spot right here. This was the golden spot to enter long calls because not only was IV in the gutter, but also price. Right. So this was just very nice. Very nice. So yeah, we could still run down a little bit. But yeah, I'm interested to see how we respond if we continue to abide by this. Because if we trade flat or trade kind of back up a little bit, certainly the options market is suggesting, based on our max pain data for the next couple of weeks, that we would kind of just chill here and maybe go sideways, which is fine. That'll be cool. That'll be tight. But even if we go to 25, you can do like deep in the money long puts so that you're not exposed to implied volatility to the downside if you want to hedge, but you have to spend a lot of money for that. So maybe don't. I don't know. Not financial advice. Yeah, I haven't decided yet even what I want to do there, besides just like, I don't know, maybe some covered calls or something, and continuing to read the tea leaves. But in any case, yeah. Let me check through the chat a little bit. Yeah, maybe, man. But I don't know. Like, I don't know why that did that back when. It might. How far down it goes, don't know. Yeah, that's right. Yeah, the last time we were about to was on the 21st. And we have not turned back from there. So like, if this matters, right? I don't know. This is what I pointed. This is what I'm talking about in my video. I don't know. Maybe this doesn't matter. But Rory and Kitty thought it mattered. And it mattered here. Mattered here. That was cool. So maybe it'll matter again. I will note that this touch of this trend line, it took a full week for this to play out. Right? That's what's important to remember with the weekly chart. So like this happened. This touch happened. What was the low for that week? It happened like midweek. The low was like 2050. Or the low was lower. The low was 2030 something. So that happened like midweek. Yeah, and then actually on Friday we had another. That Friday we had a small gamma ramp too. It was like a dollar, like a $1.50. I wrote about that too. And then Monday we blew up. Yeah. So it took into that weekend. Like we touched it in the middle of the week. We had a premature reversal on Friday, and then it was only the following week that we really went up. So hey, I mean, if we do that again, then that would mean that like next week we would start to cut back up to the upside. But then the way this chart is, to make this look like, to actually replicate what we were looking at back in 2020, it would be another like 2 months, right? Because that would be like this. That would be this touch. That would be like this or this. Yeah, that would be the 12-7 touch. So it would be like another month and a half before this, which would mean March-ish. So I guess that's actually a good segue into some other stuff. I think I've written about this too, right? Thinking about, where's the tweet? I don't want to speculate too hard because I don't know what's going on the business side of things. But, you know, the Ryan Cohen tweets, man. I have a feeling that these particular, like some of this stuff that Ryan Cohen's been up to, we're going to look back and, you know, the algorithms will have been focusing on Ryan Cohen or on Roaring Kitty, but then like one day it's going to be like, oh, wow, Ryan Cohen was telling us all the stuff all along. This is really interesting because I thought several months ago, I was like, oh, maybe GameStop's going to partner with Atari, right? So partnership with a Qatari, partnership with Qatari, partnership with Atari, the little @ sign, you know? And then, of course, if we go over to Atari, right, when he posted this, we have an Atari decanter and whiskey set, right? Right around the time he posted this. January 14th. Takes money to buy whiskey. I don't know. But then too, I think I also mentioned, where's our guy here? This I mentioned like in a post, whenever this was, like a week ago. I started writing an article about this. We talked about that last week. This one was interesting to me. And I think I pointed this out. Like, I had just talked about his tweets the previous day in my video and in my article. And I was looking at his stuff. And so I took a deeper look because he had this 10+ years experience thing in the tweet. And I have that like in my bio where, you know, I've studied the Renaissance for 10+ years is like something in my bio. And so like, do I think Ryan Cohen was talking to me? No, I don't. But that's one of those things. It's like, oh, that's a cosmetic similarity that just kind of draws my interest in and makes me pay a little bit closer attention. And I started to look up this stuff: full stack React Java, SFC headless PWA, or mobile React Native. Full stack React, like React Native, wasn't available until 2015. And specifically, like whatever the thing that, of course, I forget the name of what this PWA. That term wasn't even coined until like way later that year. So I understand it's a meme that like positions ask for people, like for, you know, IT and tech people, you know, programmers with like a certain amount of experience, when it's actually impossible in what they're requesting is impossible. Like even the people who designed the system can't fill that position because it hasn't existed for 10 years. But in the terms of React Native, this will be possible on the 26th. Like the 10-year anniversary of the release of React Native is March 25th, 2025. And earnings are probably going to be released on March 26th of this year. Maybe that's tinfoil, but I was like, huh, that's kind of cool. So that's also when around the time that if this RSI trend holds up, if this trend line holds up, that's around when we should be when we're running out of room, right? With the overbought line here, which is when GME went parabolic here, is when we started running out of room. We kind of formed this right triangle with the, I guess this would be the New Year's line, and then we ran out of room up here, and then ka-chunk. So right around here, right? End of March, and around there is when that looks like, if this trend holds up, when we would go kind of deep into that overbought territory. You know, again, if that matters. And then just the same day, Larry, what did I say? Larry Chang posted about companies needing to show year-over-year revenue growth in order to kind of finally go prove that their transformation is complete. And so I don't know, if Ryan Cohen on the 26th comes out and he's like, here's the GameStop earnings report, and they show year-over-year revenue growth, I don't know. We're gonna see maybe what they're able to do with this PSA partnership. They've been doing a lot of store closures. Maybe it's the case that we got to wait another year, but very interesting to think about. Yeah, this could be cool. This could be cool. Yeah, to do like the blockchain stuff with PSA. Yeah. That would be cool. Oh, what is this? Where's the archive? What? You found all my old Reddit stuff, dude? Do share. Share for the team. Share for the squad. Yes, Tom. Very cool. Yeah, so that's what we're looking at, right? I mean, yes, I think we still could trace back to 25. It's possible, right? Maybe that carry trade does something to us. It's not suggested in our options data. I would say the options market right now considers that to be an outlier. It doesn't mean it won't happen, but yeah, options market considers that. If this RSI trend line matters, then, you know, maybe we reverse right here. But, you know, we have to see. Try to hedge uncertainties, things like that. You know, don't go for the home run every week, something. But also keep our eyes peeled for these types of setups that we see in the gamma data and the market maker hedging data like we saw today. So exciting, confidence boosting after a week of beatdown to then, you know, to be able to pull that off was very heartening. Cheers, by the way, right? Short Fridays really came away with quite the win here, right? Short Fridays traded this for a really big gain. So very, very happy there. Obviously, right, not trading advice, but we can certainly celebrate when somebody has some great success out there. So cheers to you. Great trade there, my friend. Yeah, very happy to hear when you guys have success with what I'm providing there. So very, very happy to hear that. Great job, man. So yeah, I mean, that's what we're looking at, right? Not necessarily any kind of critical type price collapse stuff. As scary as this was, like, I know it caught me a little bit by surprise. I thought, you know, we'd get this maybe a little bit later in the week or early into next week. So I think I mentioned this too to in some places. Like I didn't even get, I didn't really get to fully properly hedge this downside move. So it definitely caught me by surprise, with how early it came. But you roll with the punches, you zoom out, you try to figure out, okay, let's get our bearings here, and then try to do better moving forward. Try to, just keep going. And for me, I think as far as my investment decision, the overall frame is still there. Like we're still seeing this type of stuff happen. Like the GameStop, the characteristic what would you say? Idiosyncrasy of GameStop is still in play. And yeah, let's I guess see what happens going forward. Any questions before we wind stuff down for tonight here? Let's see. We have some down here, it looks like. Yeah, cheers, my friend. I mean, hey, if you want, you can go ahead have like a buy me a coffee link that's on my it's on YouTube and it's on Twitter. So if you feel like sending a coffee my way, like I'll definitely drink it. Helps me get through those analytics in the morning. So I appreciate that very much. Yeah, I'm not monetized on YouTube, so maybe soon, but yeah, not yet. So thank you. Yeah, Cody with the store closures. Yeah, I mean, I look, Ryan Cohen is just doing what he said he was going to do. Like I'm sure like some of this news will come out, and whoever, Michael Pachter at Wedbush, that dude sucks. Like that guy sucks. Like you even look at him, like he looks like what is he? He calls himself like, I think on his page he directly calls himself something like a woke empath or something, and it's like, man, like who are you? What are you trying to fool? Like, are you trying to make people like, he's such a nice guy because he's a woke empath, even though he's responsible for all of Wedbush's analytics on GameStop and says that it should go below $10. He's such a nice guy for being a woke empath. Like that guy. In any case, like, the guys like that will come out and say stuff like, this is bearish, they're closing stores, like they should just, who is the guy who came out and said like, oh wow, GME is looking more, it's more like a bank stock, they should just close down all their stores, and then they can just, to stop them from getting interest on their cash because they have treasuries. It's like, okay, all right. What if they just do what the CEO had as his strategic plan from when he joined the board back in 2021, early 2021, that like everybody seemed to love? Why doesn't he just do that? Why doesn't he just do what he said he was going to do? And that's what the store closures are, So yeah, Cody, they might make this out to be something bearish, but like what was it? They just closed the one that was in Brockton, Mass, which is like, Roaring. They're like, oh, it's ironic because it's Roaring Kitty's hometown. It's like Brockton, Mass is terrible. Like nobody wants to go there. It's in like a dead shopping plaza that nobody goes to. Like, gotta get these leases off the books, right? Why do you have these stores open that people don't go to? Right, like nobody gets mad at, like, I don't know, Sephora because they're only in like LA and London and New York. Like, well, there's no Sephora in Brockton, Mass. Like, this is bearish for the company. It's like, apparently not, dude. Apparently not. Like, get those unprofitable stores gone. Get them closed. EU stuff, like, get the ones out of the EU because EU employment and stuff like that, like the way you have to employ, who you hire, you have to pay, like minimum wage laws are to a certain extent, like you have to provide healthcare, you have to provide like 2 years of unemployment benefits, stuff like that. It's like, if your store's not profitable, it's like, okay, do you keep the store, like what's worse? Do you keep the store open at a loss and hope it gets better and like hope the loss, would be okay to offset for like 5 or 10 years or something like that? Or do you just like pull the plug and then pay all those severance benefits for 2 years? But then, once they're done, and then you move past it. I don't know. But, it's what Ryan Cohen said he wanted to do back in 2020. In November of 2020, he said this is what he wanted to do. So he's executing the plan. I don't know why anybody reasonably looking at this would go like, oh, what's going on? So, yeah. Me too, dog. Me too. Yes. Especially after an okay Monday. They really threw a curveball there because like we had the 11/29/12/2 dip, which was a Friday and a Monday, but then waiting until Tuesday. Okay. Tom says, I have a question. Saw Region Formal's post about Citadel selling bonds to fund a payout to the owners, which is primarily just Ken Griffin. 85% is Ken Griffin. So it's probably better to call this selling out. It's a funding a payout to Ken Griffin. Is a better way to describe that. It seems like Mr. Citadel is pulling some money out. Think he's worried about the future. Don't know, man. Don't know. I wish I knew, right? I know I have chart of GameStop. I know the chart of GameStop. Like that's, I don't know, dude. That'd be cool if he was, because like that guy sucks. But I don't know. Good question though. Did he really say that? Did he really say maybe buy for his yoga shop? There's always money in the banana stand. Yeah, dude. It's hold till expiry. What's the worst that can happen? Yeah, it would be. I don't know why we would do that, but that'd be super cool if we did. The reason why, like, so the thing about, right, the thing why sometimes you don't see that in the after hours, but you do see stuff like this, is because you can't do anything with options here. So they try to avoid that stuff if they can because it doesn't benefit their options positions. Yeah. Well, you can buy cash secured puts if you want, right? So not trade advice, but in that situation, that's kind of what a cash secured put is designed for. So the thing is, it's like if you want to buy shares and you want to buy shares at a discount, you can say, okay, like I would like to buy shares. Like if it's going to go to 25, I'd like to buy at 25, but I also want the company to go up, and I don't want to miss out on some gain if that's the case, right? You can hedge that, and you can say, okay, let me go buy like what would you say here? 2 weeks out. Can you get CSPs? Yeah. Yeah. So you could sell like, let's say maybe you think it's going to go to 25. You want to buy 100 shares. Sell one here, 25.50 or 25, something like that, right? You'll get a bit of premium, which means if it actually doesn't go down and we just immediately reverse and then go up, well, congratulations. You just get to pocket the premium, right? Free money. If not, you get assigned the shares at a cost basis of, this, the strike price. So let's say 26.50 or 26 minus the premium. So pretty good. Like you'll get a pretty good price on that. As long as, as long as it doesn't keep going down infinitely, but hopefully not. So you can do that. Like if you're in that type of situation where you don't think it's going to go, you don't have strong conviction about one eventuality or the other, that can be a solution. That can be a solution to hedge your risk, right? Hedge your risk of missing out and hedge your risk of not being able to get in at a better cost base. Great for employees, bad for business. But I mean, it can be good for it can be good for business. Like it prioritizes. What it does is it makes European businesses less interested in taking risk, right? So like European businesses are going to prioritize hiring someone that they can keep long term. They know, like they're like, wow, this is a surefire bet. This person's really qualified. Like they're gonna do great with the company. They have a ton of experience, something like that. But it basically encourages organizations to like double down on things that other people have already had success with. So, for example, the European academic job market is terrible because number one, academics are in terms of risks, academics are the least risk-taking people that exist. They like academics do not know the meaning of taking risks because they're like obsessed with knowing, right? Academics, their job is to know things to as deep a depth as possible. And so they're used to focusing on knowledge. Okay, well, like with trading and stuff, like there's too much knowledge, there's too much information that you need to act on. Their job isn't like necessarily acting on knowledge, it's on presenting ideas and being able to argue persuasively to a high degree of conviction with respect to some idea, whether it's wrong or not. So they're not risk takers, right? They don't take risks. And so that's a job sector that's already super insulated from risk. In the EU, people don't even like I was applying to a job in my field, and I was runner-up candidate for a postdoc in Austria, and the guy who got the job, like this guy definitely should have gotten the job, right? This guy he was like 13 or 14 years post PhD. I was 1 year post PhD. I wasn't even a full year post PhD. I had done some research in the ballpark, but like I had only just finished my PhD in the US. So like I definitely knew my stuff, but I was fresh, right? Whereas this guy had 13 years experience, had like over 40 publications, not including his dissertation, had like 3 or 4 postdoctoral fellowships already, discovered a lost manuscript from a famous Renaissance historian. And like this guy was applying to the same postdoctoral position I was because there were no jobs for that guy. There were no professor jobs for that guy. Like that guy should have already basically had tenure. If that guy was on the US market, like that guy would already have tenure by a long shot. Like, so with EU hiring laws, yes, it's great in terms of the employees once you get a job, but it also makes it way, way more difficult for people to get that kind of quality job because employers are far, like businesses are far less open to taking risks because the penalties for taking risks are so great. That's the drawback there. So, let me see. There's a lot of significance, but basically, I'll say this. For me, it was very significant to have another data point that says I'm not crazy when it comes to reading market maker gamma exposure. Number 2, we were correct to make a comparison to the attempted beginning of the volatility cycle back on December 5th, and that Roaring Kitty's tweet was an interruption of some of that. that the types of dynamics in our implied volatility data, in our market maker exposure data, that how that interacted with the tweet, right? Like how that interacted with the post or the hedging response, or I suppose the buying response to that post was consistent. And that probably it means that algorithms, institutional algorithms, whether it's market makers, whether it's hedge funds, who knows, maybe using probably some kind of machine learning to, like, they may be training their like trading algorithms, or like maybe they're using like AI or something like that to try to predict when Roaring Kitty will make a post, and then to buy according to that. And what's very interesting about this is after we went into a volatility cycle that looked just like it did back after Thanksgiving, so 11.29 to 12.5, right? We went through basically the same beats, right? That's the same archetype of moves. We have the same sort of setup in the options chain. We had the same sort of gamma exposure, dealer gamma exposure, and then at like down to the minute, then we had the same type of volatility squeeze occur heading into OPEX. Very, very interesting to see that happen. So what that says, and where did it stop? Let's extend this to the right. Hey, if we extend this to the right, it probably stopped right at the top of the regression channel here. Wait, how do I extend this? Extend the right. Yep. I drew this today. All right. It was a little shy. I won't be crazy there, but yeah, I didn't go quite up there. But certainly that we got this type of move in this type of setup that I don't know how else you explain this other than algorithms or something, trying to anticipate when he'd post. Because right, we were all saying this. We were all thinking this week. I was talking about this week. Hey, these are the conditions. These are the conditions. They're going to come, right? And it went down to the wire, and then something triggered this type of move without him actually having to do anything. So it calculated this is when he would do it, and then set that off. And then he just did, but he chose not to. He didn't do anything, which is very interesting. I have not yet had too much time to look at swaps yet. I might check that out over the weekend. Where's the link? Somebody posted a link here. Where is this? Didn't see the link. Yeah, man. It was instant, dude. Guido, love your name, man. Great name. Yeah, it was instant, man. And 4 million shares in a second, bro. 5 minutes. Yeah, dog. It's wild. That's possible, actually. It could have something to do with margin call. Like maybe somebody got margin called 28 days before. What would be 28 days before then? Because Rec 68 is 29, T plus 29. Let's look. So 5th, 7, 14, 21, 28, 29. So that'd be November 6th. What happened then? Maybe. We had this, yeah, we had this weird after hour stuff. Maybe. And then it sold off. Don't know. Don't know. If this was a Rec 68. I mean, it's a window, right? So it's a 29-day window. So it could have been after that too. Why it would come there? Not sure. Yeah, that's right. Mhm. Yeah, he bumped it up, and then Cohen ended up not giving them a liquidity valve. Yeah, yeah, yeah. Interesting. Yeah, I hadn't had a chance to go check out the trade. Can we see it here? It's possible. Somebody still chose to make that buy. Yeah, we had 0 DTEs. But it's not enough. It's not big enough, I don't think. Look, yeah, they but that's a million. Like that's not that much. Oh, what happened here? Maybe it started the ball rolling or something, but this trader didn't even exit. There were 2,000 that came in at the ask. Well, okay. So that would be 200,000 shares. So yeah, 200,000 shares. That probably would actually that would be enough. That would be enough to kickstart it. It's not just this. The 1 million. Yeah, the 1 million there is not enough. It's that it was probably chained with a bunch of other. They didn't chain it though, right? So this is a part of it because it was bought in like tranches. So, but that's no, but that's too. That's like too early. Some of these are too early. I don't know. Maybe they just chose not to do it. Let's go down to 1 day. Because they came in here 500. Did somebody go out here? This order alone, no, see, it's only, yeah, we had to be 100,000. That's a lot, but would that be enough? That wouldn't be enough. That wouldn't be enough to do that whole thing to disrupt that. But maybe it would have been enough. Just like the rest of that was just dealer hedging. It was like that was all gamma ramp or something like that. Because this came in at 110. So this came in here. So yeah, the dealer didn't fully hedge it here, I guess. But how much was that one specific order? Because you have to go by contracts. And you say, okay, they got to hedge the whole thing. It's 952 at that time. So that's 95,000 shares. I don't know, man. They could have gotten that in here. Done it slowly. There was another one, 500, so that would have been 50,000 shares earlier. 12. 12. They could have hedged this in here. Yeah, it's like not. Yes, they had to hedge the whole thing, but it's not like they could have done. This is something different, man. 180,000. Like if they didn't, I mean, if they just waited until that time to do it, and then they hedged all of those contracts at that time, then yeah, the 180,000 shares all at once would set off a hedging reaction. Would set off that gamma ramp. But they're spread out, like they were spread out all in here. They weren't like it was like 3 or 4 orders that were in here. So there was one at 115, there was like one at 12.15 back here. So, and we do have some volume spikes close to that. Not the whole thing, but we do have some chunk orders like coming in there that don't blow us out. So I don't know, man. Clearly a lot of this volume was the setup, was hedging, but something else did that, I think. Do institutions work with market makers or whoever to immediately halt the upward movement so that they can get into protection mode and start covering? That's a good question. I mean, I don't know for certain, but I would guess that because I see these turn around like at certain points, like with respect to the because the institutions that maybe set this stuff off, like they know how the market maker is exposed, so they kind of anticipate when this thing is going to run out, or they sort of watch like how much people come in or something like that, or if people are going to come in, if another institution is going to come in on top of them. Like this is such a rocket. Like this is such a tear that, I don't know. I mean, sometimes they have their own like Citadel has a market making arm and they have an asset they have asset management and they have their securities and stuff. So they have both arms. Wolverine Trading is the same. There's Wolverine Trading and there's Wolverine Asset Management. Wolverine Trading is the designated market maker for GameStop options. But then they have Wolverine Asset Management, which is not. That can trade and do whatever. And they're not beholden to the requirements that are put on Wolverine Trading as the options market maker. Apparently not a conflict of interest. Let's see. Today was the culmination of a cycle from 12.5. Why do you suppose we didn't get an externality to accelerate that like we've seen in the past? Well, I mean, yeah, I don't know. See, part of what we had in December was we had earnings, right? And we didn't have something like that here, and we didn't have something like that. We don't have something like that coming up. So same thing with September 6th. Both times that Roaring Kitty did this, we had right, kind of that we had these dynamics. September 6th was the week before earnings. December 5th was the week before earnings. Maybe we didn't get something this time because it doesn't have to do with earnings. We're not like kind of in the midst of this. And yeah, we're like, this is a long stretch. We have until March here, something like that. I don't know. Like maybe he also wanted to part of his like, I was thinking about this earlier today. He has to do, right? You know, he has these Dune memes. He has to like do the sand walk, just like these guys do the sand walk, right? The sand walk from Dune is you have to move in this kind of the Fremen move through the desert in this rhythmic pattern that has it's unpredictable, right? There's not a set rhythm. There's not something excessively predictive. Like when you put the thumper, the reason why the worm comes is it's attracted to steady rhythmic beating. So if you walk normally through the desert, you have like this rhythmic, obligated, habitual bipedal locomotion attracts the worms. So you have to learn the sand walk so that your movements are unpredictable, so that you imitate the sound of the desert. If Roaring Kitty posts every time at the same time during one of these cycles, then he's going to be too predictable, and then maybe they can hit him with pumping and dumping or market fraud or something like that. But turns out, and this is what's interesting, I think he might also be trying to point this out to other institutions. Like it doesn't have to be him every time to exploit this. Other people can come in and do this. I spotted this. I don't have the money for this, but like, I don't know. There are other people out there that do have the money for this, that can set this up in their favor, that could do it once and then, so maybe that's why we didn't get something like that. Oh, cheers, my friend. Yeah, hey, let's talk. Like, shoot me a message on Twitter, and we'll talk maybe about like some stuff that we could do. Yeah, I can try to come up with some ideas. But thanks, man. I appreciate that. Yeah, that would be, yeah, I think so. Yeah, I don't see why they would stop. They'll keep doing this stuff. I mean, this is right. They'll keep doing it as long as it works. Maybe. That's a good thought too, Narwhal. Yeah, maybe they exercised. But that would have been fully hedged. Like, ideally, I guess we don't know, right? But that should have been fully hedged. Because when those got bought, like $15 call has a delta. Like if we look at the delta, has a delta of 1. Look, anything below, right, basically like 26 or something today, like anything below like 25 had a delta of 1. So they would have had to perfectly hedge this as soon as it was purchased, because no chance it wasn't going to close in the money. So that shouldn't have mattered, because they should have already been hedged. But maybe they just didn't hedge it, and we're going to wait until like after hours or something to get the shares, because it's T+1, so they can do that, I guess. But if you exercise it, it's delivered then. They have to deliver it to you then. So maybe. Oh, that sucks. Yeah, if you guys have any links, like send them over to my Twitter. My Twitter's linked. Like you can get me on the messenger there. My Twitter's linked at the top of my account, and of course, you can just follow my articles too. You can send me some links there. He may have. Yeah, it may, but I mean, he may have done that not with the intention of exacerbating what was going on. He may have pointed out that that was going to happen. And then there was an overreaction because he made a post. But this time he didn't post and it still happened. Yeah. Yeah, that's super cool. That's right. Doesn't have to be him. I'll take another look, see if we saw some big orders this weekend, but yeah. Yeah, could. What? I that's quite the question. Deep boning of the stock next week following this OPEX. I don't know. We could go to 25. We could. As I said, right now it doesn't look like the options suggest that coming out of the gates. We'll have to see how that shifts once I get a peek at the data. But yeah, I don't see that right away. Yeah, maybe. Yeah, maybe. That's what I pointed out earlier too. Oh, that's interesting, Guido. Huh. So maybe this has to do with a swap, huh? Swap Clear has 3 scheduled intraday margin cycles at 5:45 a.m., 10:45 a.m., 1:45 p.m. EST. Huh. No, interesting. The PP show. Huh. Don't know the PP show. I'm gonna leave myself a note here. Hmm. Some good things to think about. Yeah. I think that'll just about bring us to a close for today. Definitely exciting. Always a great time talking to you guys. Thank you as much for your questions, your ideas, participating, watching, and listening, supporting me this week and stuff. Like, thank you so much for leaving comments. Thank you so much for continuing to support the channel and support what I'm doing here. I really just want to try to figure this out, right? It seems like for as little background I guess as I have at this, it seems like I've been pretty fortunate on some of the stuff I've been able to stumble on. So just trying to put the pieces together, just kind of follow along the story, like Richard is as well, and try to share some wisdom out there too. So we can all just be better informed as to, you know, what the real stock market is, right? What that real market is out there. Certainly. So yeah, I appreciate you guys. Definitely. Like I said, if you have links, go ahead and send those my way on Twitter. Yeah, look forward to seeing you guys back for Monday's video, for Monday's article. Hope you guys enjoy your weekend. Thanks so much again, and let's go GameStop. So thanks very much, you guys. We'll see you next week.